Well, good morning, everyone. Welcome to you, wherever you're watching this webinar. My name's James Trainor. I'm a partner here in BDO's tax practice in Sydney. And this is the next one in our series of Working in Australia. And this session is going to be about payroll compliance. And before I get to introducing the other presenters with me today, we'll just touch on a couple of the housekeeping requirements. So hopefully many of you have used this webinar before. If you've got any issues with your audio, then there are some instructions on the side there. Just follow the prompts. You'll automatically be muted, but if you do have any questions, you can submit them on the questions pane, and we'll endeavour to get to those as we go through the session. If not, we might need to come back to you after the session concludes, but we certainly welcome questions as we're going through. The presentation slides that you are looking at, they will be available as handouts for you to download, and also they'll be sent to you at the end of the session. And there's also a link there, so if you've got any problems with technical issues, please just follow that link, and hopefully they can get you sorted pretty quickly. So with you today, three of us, so two of my colleagues. So we have Stefanie Merlino, who's a partner in Melbourne. And we also have James Henry, also from Melbourne, who's a senior manager in the team down there. So what are we going to be talking about? We're going to go through some of the payroll issues that are relevant for employers, and touch on some of the areas where we've seen challenges that employers face, and also where we've seen activity from the revenue authorities, whether that's in the federal income tax space or in the state payroll tax space. So James is going to talk about pay compliance, awards and EBAs. And for anyone who's opened the paper in the last few years, wage theft has been certainly something that's been appearing quite regularly, and employers still struggle to get this right. And there's a whole range of reasons for that, not necessarily theft. And so James is going to run through the challenges and the issues that are faced by employers in that space. Steph is then going to take us through superannuation and employment taxes and look at some of the challenges for remediating errors, where they've arisen, and how to engage with the regulators to correct those errors and remediate sort of historic issues that might have popped up. Finally, I'm going to touch on employee share schemes, a little bit of a recap around the obligations to report employee share schemes to both employees and the ATO, and also then touch on some amendments. What happens if you don't quite get it right? So sit back, hopefully enjoy the session, and without further ado, I will hand over to James.
Thanks, James. As James said, I'm the other James. I'm a senior manager in BDO Melbourne based, and I work in pay compliance primarily, and some of you may know it as pay compliance. Some of you may know it as wage compliance or payroll advisory, and it's as James alluded to, that recent topic of wage theft, and really it's quite an unfair name to label it, because there's a lot more factors to be considered than just whether it's wage theft or direct employer malice. So I want to keep it at a high level to start off and make sure everybody is on the same page. So what does it mean, and what does it mean when we say pay compliance? And the easiest way of explaining it is it's ensuring that an employee is receiving at least the minimum amount that they're entitled to under the law. What does law mean? And there's many different aspects of law that needs to be considered here, and that ranges from national employment standards, which would be the minimum hourly amount that everybody's entitled to in Australia. It might highlight the leave entitlements and all those basics that everybody's entitled to at a bare minimum. It would also mean the employee contracts, so specific employee contracts and what employees are entitled to under those. It might mean industry award, which we're going to focus on today, which would be the additional minimums that an employee is entitled to under the specific industry award, so the role that they have or the industry that they're operating in. And also, to add to that, enterprise bargaining agreements. So some of you may know what these are and some of you may not. They're similar to industry awards, but they would be specifically negotiated by an employer to operate under that rather than just the industry award. So why is it so important, and why is it such a topical area today? And I've listed some key areas here that should be in employers' mind and businesses' minds with regards to pay compliance. The first and foremost is employee satisfaction. Employers want to keep their employees happy, especially in this tight market for recruitment. Dissatisfaction can spread amongst their workforce fairly quickly, and it can also, in these times where information is so readily shared, spread throughout the market, which can really affect a business's ability to be able to recruit in a space. First and foremost, employers want to be happy that their employees are happy, because that's how they will get the most out of them. Legal requirements, so I just spoke to this. Employers are obliged to pay their employees appropriately. Media attention, so probably why it's become such a topical area is all of those articles that people are reading in the last few years, which really leads to negative PR. When you read those articles and you read about those companies, you probably have a negative perception in your mind as to, was it wage theft, was it purposefully done? So no matter what the actual reasons are, should media attention be drawn to the fact of an underpayment, negative PR will arise. And that is also important for a business to consider in terms of its business operations. Customer perception and the ability to win new customers down the line can really lead to business losses if this is quite a big area for your business. Another one that people don't really think about is the remediation costs and effort. So if you're paying your employees appropriately now, you will not need to worry about a big bill down the line. If you are ignoring the fact or ignoring compliance, then there's problems that can arise where you may have millions of dollars to pay in future years at one specific time, and it can really be a big impact to a company. Other parts of remediation is the actual effort involved for employers to undertake, both with costs for external consultants and also efforts involved in the specific teams in a business that they will need to focus on and will really take away from their business as usual activities. So moving on to the next slide, we've got industry awards. So you will have heard me mention that the main focus is around industry awards. And the reason for that is that this is where complications arise. National employment standards are relatively basic and apply to everybody, but an industry award is very industry specific, as you would imagine. There's more than 100 industry awards in Australia, and that doesn't include all the enterprise bargaining agreements that I alluded to earlier that an employer may have negotiated for themselves. So understanding compliance and controls in this area is obviously very important for an employer to consider. So a background on industry awards and what they cover. So while you would have heard me say that there's more than 100 industry awards out there, they all vary in their clauses, but they all have the same fundamental basis of areas that they try to cover off on. And the first and foremost is the minimum rate and the classifications that an employee is entitled to. So classifications would be, for example, level 1 to 6, level 1 being paid $20 an hour, level 6 being paid $28 an hour, as a very high level example. And that changes based on an employee's role and responsibilities. And the awards go into great detail in the appendices of outlining specific roles or requirements of an employee that can change them from a level 1 to a level 3 or whatever the terminology in that award is, and the associated minimum rates that the employee is entitled to then. Penalty and overtime rates are on top of these. So penalty rates might range from an additional 50% of the minimum rate on a Saturday or 100% on a Sunday, or a specific dollar amount like in the hospitality award for evening hours, where there's maybe an additional $3 per hour or part hour for each worked past a certain time. Overtime rates, these are on top of the minimum rate again, and can range from 50% for the first 2 hours to 100% thereafter, or even 150% maybe on a public holiday. How employees can be rostered and ordinary time. So this is very important because number one, overtime may generally be alluded to as outside of ordinary hours. So then you need to look back to what your ordinary hours should be. And complications can really arise in this area. It's not just a minimum of 38 hours. Some awards might be, but there's generally more to it than that, such as maximum daily hours or a specific span of hours, which I'll talk to in a moment. And finally, another key area is allowances. So allowances as specified under the award, and this can really lead to problems where an employer has ignored allowances, and it turns out that because of the actions that an employee's role requires, that an allowance is owed to them. And depending on how an employee contract is set up, this can really lead to offsetting problems where the normal inflated pay amount that an employer might pay isn't actually allowed to cover the allowances that should have been paid. And we see that can be a common trip up of employers as to underpayments arising. So just to talk to those a little bit more and some common pitfalls and common areas that we can really see where underpayments can arise pretty quickly without any intended malice, but maybe just a lack of compliance and a lack of regular reviews and checks. So coverage and classification, the first and foremost being an employer operating under the wrong award. So the wrong award coverage, meaning that they're missing the specific rules of that award, or thinking that they're not covered by an award and maybe turning a blind eye to the problem. And subsequent to that, classification of an employee at the lower level. So maybe considering all employees to be level ones, whereas some employees might be required for example, closing up in the evenings or opening up in the mornings, and that might boost them to a level 2 or level 3. Incorrect rostering and impact. So I spoke to ordinary hours and rostering a moment ago, and it can be quite complicated in certain awards as to how employees can be rostered. For example, in the retail award, it's 38 hours, but there's additional complications such as maximum of 5 days a week. That further extends to if you have 2 days in a row off, which you're supposed to have, they need to be in a row. So in that instance, if an employee was rostered to not work on a Monday and a Friday, you're actually breaching the award there, because it should either be the Monday and the Tuesday, the Sunday and the Monday, 2 days in a row. And another quirky one that the retail award has is every 4th Sunday, an employee should be rostered off. And that is really difficult for a business to operate in day-to-day terms when they set their rosters weekly, and they don't really give much consideration to the previous 3 Sundays that the employee has worked, and can really trip them up. Overtime, so there's many reasons as to why overtime might arise, and it's really based on those ordinary hours, which would include minimum of 38 ordinary hours or maximum of 38 hours, a maximum of maybe 8 hours in a day. But also a common really trip up is around the span of hours. So some awards have it and some awards don't, but where they do have it, it might specify that the span of ordinary hours that an employee can work in is Monday to Friday between 7 a.m. and 7 p.m, for example. That means if you worked pre 7 a.m. or post 7 p.m. on a Monday to Friday, you are in the overtime category. However, where it's more likely to arise is it also means that if you worked on a Saturday or Sunday, you're entitled to overtime for all those hours worked. Another common occurrence we can see is a reliance on an inflated rate. So a lot of employers might have the opinion that, well, we pay our staff well above the award in terms of their hourly rate, and that covers us for penalties and overtime. And that might be the case, or it might be the case for a very short period, because depending on changes in how the business operates and how employees are rostered, it can really affect as I just alluded to it, weekend hours can be treated at double the minimum rate, and it can really eat into that inflated rate very quickly, and that inflated rate can be outdated very quickly as well, as the awards change annually and rates regularly increase. And finally, ignoring allowances. So I spoke to this already, but ignoring allowances can be a big problem, and depending on the award, for example, the manufacturing award or the building and construction award, are really quite onerous in the allowances that an employee might be entitled to. And it's really important that an employer gets to grip on those allowing on those obligations that they should be meeting. So moving on to the next slide. So a growing concern. So why we're all talking about payroll compliance, why you're at this webinar today, and why it's at a forefront of most people's minds is really down to a number of factors and where it becomes to the forefront of people's mind. So obviously we spoke to the media attention, and you've got those high profile examples, the likes of George Columbaris's Empire, the Woolworths case, the ones that we read about in the newspapers. And that means that the people who are responsible internally in a business aren't the only ones considering payroll compliance or award compliance. It's also the people reading those articles who might be on the board of a business or who might be in a different area of the business and realize that it's something that they really need to get to grip with. On top of that, employees obviously read those articles as well, and employee awareness of their entitlements is at an all-time high. And we see a real increase in employee complaints as they understand the award more, they understand what they're entitled to, and they raise those complaints internally. It's really important for an employer to address those complaints before they get out of hand and the employee feels like they need to go to the Fair Work Ombudsman. And it's really important for the Fair Work Ombudsman point of view that an employer has a system in place to be able to address employees' complaints. It doesn't mean that the employees' complaints will always be correct, but it's on the employer to really investigate and make sure that they're operating compliantly with the award. Fair Work Ombudsman. So this is always going to be a key driver, but it's Fair Work Ombudsman have really amped up and upped the ante on their auditing of employers. And that is what's driving these the media attention. You can really see, I'm not sure if anybody has read the Fair Work Ombudsman annual report, but it's quite an interesting one in this year, and it recently released and showed that Fair Work Ombudsman recouped in excess of 500 million in 2022 alone of underpaid wages. And it's also important to read from your business's perspective because it shows the focus areas that Fair Work are focusing on. And that includes the hospitality industry, various other industries like education and universities, sham contracting, and many different areas that if you feel like that your business operates in, that you really should consider a review to ensure that you're comfortable. And if the Fair Work Ombudsman perform a random audit, that you will be comfortable in knowing that you're operating correctly. Another one is business acquisitions and due diligences. So it's become quite common in due diligences for a review of pay compliance to ensure that employees have been paid appropriately. And why that is the case is because businesses acquiring businesses or somebody acquiring a new business, they really need to be comfortable that they're not going to be faced with a huge bill down the line of underpaid wages that they really weren't responsible for. So it's important for them to know of these possible liabilities up front, and that has also triggered some extra reviews or more regular reviews. Role requirements, so generally it can tend to sit in the human resources and payroll departments, whether on purpose or whether by accident and it's just fallen into somebody's lap. But for a long time, it may not have been the priority in these people's roles to focus on award compliance. That is changing, and it's important that people get up to speed with that. And these role requirements and increased requirements of your role really need to be considered. And it's important to consider that your staff are capable and trained enough to be able to deal with that. And annual and regular reviews. So we're seeing a lot more regular reviews from employers because, as I said earlier, awards change very regularly. It's not just the annual rates. Sometimes the format of an award can change, which can really impact it. Sometimes the specific clauses can change, and an employer really needs to be on top of it very regularly. First of all, to make sure that there's not a long gap since a previous review where mistakes could have arisen, but also so that it's comfortable that it's consistently up to date with the award requirements. So moving on, areas to check. So these are some key areas that really you should ask yourself these questions and considerations of, do these affect your business, and are we happy that we're comfortable with them? So the first one is, do you know your industry award? So this will be a pretty big red flag if you didn't, or if it's not your responsibility, does the person who's responsible in your company are they across the industry award? Do you have an idea of the operations of the industry award? And do you know how the industry award affects your business decisions and how maybe you roster your employees to work or the times that your employees work? When was the last time you had a review? So I said in the last slide that reviews are becoming a lot more regular, and it's really important to consider when was the last time you had an either internal or external review of your pay award compliance and your payroll processes, and whether it's time for you to consider that either a regular recurrence or an entire review historically. Annual salaries. So annual salaries is fairly common in the press at the minute as well, in terms of a lot of employers were comfortable that they were paying annual salary, so maybe they didn't feel that the award was as applicable to them. There's been additional clauses put into certain awards around annual salaries and what an employer must do if they're going to operate under an annual salary, such as understanding the outer limits of hours for overtime and annual reconciliations for employees, even if they are paid an annual salary. So it's quite an onerous burden on the employer, but one that they really need to be aware of. And the bottom three are really important here because it really circulates around how you are managing the process of award compliance and how you're operating your employees. So how do you record your time and attendance and convert it into pay? A lot of employers may have previously have had a manual approach, and really that's quite outdated at this point when you consider the complications of the award, and it might be time to consider moving to a more automated approach. Where an automated approach is there, or a clock-in or system or more sophisticated software, it's important that that's not just the answer. The problem isn't solved at this point, and regular reviews and having the right people understanding how that operates really needs to be in place to make sure that it's being used effectively. And it's not just that it's installed or the software is there and that we must be compliant at this. We must be compliant once we have that. So what processes do you have in place as an employer to maintain your compliance? Do you have your regular reviews? Do you have matrix documents to perform regular checks on your pay? Do you have your time and attendance system set up correctly, and who the responsibility lies with? So do you know who in your business is looking after this? Is it you, and do you feel like you have a good grip on it, or do you need extra support from the wider business? So these are just some initial questions to ask yourself to consider whether you need to change your processes or increase your controls over it. So finally then, pay compliance and what we generally do. So the service offerings that we tend to operate in this area vary from, the majority is either large reconciliations or small sample reviews. So a large reconciliation would include a full calculation of underpayment to arrive at a specific dollar amount for an employee over a specific number of years so that they can be paid that amount of underpayment that they're owed. This can arise from Fair Work Ombudsman having investigated an employer and realizing that they've been underpaying their employees and that this needs to be paid back to them. It can also arise from an employer doing a check and realizing that they weren't paying their employees appropriately and wanting to do the right thing and own up and ensure that their employees are paid effectively. What this generally involves as well is the need to build a model or build a tool that would process the time and attendance data of the employees and calculate the minimum amount that they're entitled to under the specific awards. At a higher level, where an employer isn't sure or wants to gain comfort over their award compliance, we also perform some sample reviews. These can be high level or they can be relatively focused on specific areas and generally are in the form of a health check as part of a due diligence. And their aim is to identify the weak areas and produce a red flag report to indicate those to the employer. Finally, some other service offerings in this area include payroll process risk and control reviews. So an overall review of your payroll processes and whether the controls that you have in place are sufficient for your award compliance and for your pay responsibilities as a whole. And also the tax and superannuation impacts of remediation, which Steph is going to talk to shortly as well. So that's it from me. hand over to Steph now to talk to you about superannuation and employment taxes. Thank you.
Thank you, James, and good morning, everyone. James did a great job discussing pay compliance, which is an incredibly topical area at the moment. With such a big focus on employee entitlements by government and the various regulators, it is great to see that employers are proactively reviewing their pay compliance, and where any non-compliance is identified, we're seeing remediation through backpaying employees. However, remediation of underpayments leads to superannuation and other employment tax obligations. So as James mentioned, I'll be spending the next few minutes providing an update on some of the key superannuation changes, followed by an overview of the superannuation implications of employee remediation and other employment tax considerations, specifically covering payroll tax and work cover. So to begin with, and I'm sure you all know what superannuation is, as I'm sure everyone's receiving it, but super is a mandatory obligation to support an employee in retirement. The SG rate was 9% for many years and increased to 9.5% from 1 July 2014. And it remained unchanged until 1 July 2021, when it increased by a further 0.5% to 10%. Federal government was committed to ensuring employees are adequately prepared for their retirement and have sufficient retirement income. So over a number of years, they legislated a number of years ago, they legislated a 0.5% annual increase to the SG rate. And I'm sure many of you, if not all of you, are aware that the rate increased further to 10.5% as of 1 July this year. And a further 0.5% increase will apply each year until the SG rate reaches 12% as of 1 July 2025. Now, what does this mean? So employers should ensure that they are budgeting for these increases. If you remunerate your employees on a base plus super basis, the increased superannuation will mean an employee is receiving more superannuation contributions and their gross take-home pay should remain unchanged. So base plus super will mean there's going to be an additional cost to the employer each time there's an increase in the SG rate. However, if you remunerate your employees on a total employment cost, the increased super guarantee rate will result in a change in the gross take-home pay to the employee and the SG rate. So there'll be an increase in the SG contribution that the employer is required to make, and there'll be a corresponding decrease in the gross take-home pay, all things being equal. So I know from previous changes that have occurred, we are seeing employers choosing to provide an uplift to employees, particularly where they're remunerated on a total employment cost, so that the employee doesn't feel worse off, particularly given today's inflationary environment. So again, something to consider and to ensure you are budgeting for these additional costs, particularly where, well, if you pay under a base plus super model, but under the total employment cost model, if you are choosing to uplift. Now, in terms of what an employer is required to calculate SG contributions on, superannuation arises on an employee's ordinary time earnings, or OTE. So in other words, an employee's ordinary hours of work. This includes salary or wages, most allowances, bonuses, and commissions. Some examples of payments that are not OTE include overtime, provided the overtime hours are not so regular that they become an employee's ordinary hours of work. Certain allowances, such as expense allowances, where there is a reasonable expectation that the amount will be fully expended, is another example of a payment that's not OTE. So an employee's superannuation entitlement is calculated as the superannuation guarantee rate multiplied by the employee's OTE. Now, there is something known as the maximum superannuation contribution base, and I've set that out on the slide at $60,220 for the current financial year. What this means is an employer may cap contributions for the employee at the SG rate by the applicable maximum super contribution base per quarter, while still complying with their obligations under the superannuation guarantee legislation. So as an example, if an employee earns $100,000 per quarter, then an employer is only required to contribute 10.5% of $60,220 in the current financial year for that quarter, in order to comply with the obligations under the SG legislation. Now, it is very important to note where there are industrial instruments or an employment contract that provides for higher entitlements, then those additional obligations must be met over and above obligations under the SG legislation. And I've also set out on that last point on the slide, there was also the $450 per month eligibility threshold removed from the SG legislation effective 1 July 2022. So that's a recent removal, a recent update, which means an employer no longer has that threshold to determine whether they have an obligation, a super obligation for an employee, regardless of what an employee earns from 1 July 2022, the employer must contribute super. Now, moving on to the next slide, annual leave loading, very contentious one. So for a number of years now, annual leave loading has attracted a lot of attention and scrutiny from the ATO in relation to the superannuation treatment. The ATO's position, it's stipulated in SGR 2009-2, it's a SG ruling that covers ordinary time earnings. The position is that such payments will not be considered OTE where they are demonstrably referable to a notional loss of opportunity to work overtime. Now, I've set out a case on the slide. It's Finance Sector Union of Australia against Commonwealth Bank of Australia. This was a case that was heard in the Federal Court and Family Court of Australia in July of this year. The case involved a union who represented the interests of an employee who had been working with the CBA since 2004. The individual was entitled to annual leave loading under the applicable enterprise agreement, and of particular relevance for the case were the 2014 and 2016 enterprise agreements. The employee worked overtime and was paid overtime payments on occasion, and was also entitled to annual leave loading of 17.5% of her base rate of pay, typically paid in around January each year. CBA did not contribute superannuation amounts on your annual leave loading. The judge concluded in this case that annual leave loading was not OTE, and instead it was a higher loading and not an ordinary rate for ordinary hours of work. Notwithstanding the ATO's position that annual leave loading must be demonstrably referable to the notional loss of opportunity to work overtime in order to be excluded from OTE, the court did not conduct any analysis to validate this. Instead, the court put more emphasis on the fact the payment was not paid at the employee's ordinary rate of pay, nor for ordinary hours worked. And the court then concluded that annual leave loading was not OTE and instead was a higher loading and not an ordinary rate for ordinary hours of work. So I wanted to raise this case as it's an interesting decision where the court has not considered an established ATO position on annual leave loading, which potentially may have led to an inconsistent outcome. Hence, if you do pay annual leave loading, I encourage you to have a read of the case. However, I also greatly discourage changing any current positions based on this case, as we have not yet seen any updated guidance issued by the ATO on the superannuation treatment of annual leave loading. Therefore, the ATO position continues to be as set out in SGR 2009-2. And another important thing to note, and I'm sure you're all familiar with Single Touch Payroll Phase 2, which was introduced 1 January this year. STP Phase 2 requires employers to report annual leave loading. So there's more transparency and potentially greater scrutiny to be placed on an employer's superannuation compliance. So yes, very important update if you pay annual leave loading. And some further updates, I referred to SGR 2009-2 before, that is the ruling on OTE. We have seen some changes that have been made and an addendum issued on the 19th of October 2022, so just a few weeks ago. So the ruling's been updated to remove the $450 per month salary or wages threshold for calculating an individual SG shortfall, and also a corresponding change to the regulations. There's also been a withdrawal of the Superannuation Guarantee Determination 2003-5 that covers how the exclusions under sections 27 and 28 of the SG legislation interact. And this withdrawal took effect from the 20th of October 2022. So just some small updates in case these are of interest. And now this, I think, has a lot of relevance and covers off on remediation. So particularly where, as James discussed, pay compliance, I wanted to cover what does that mean from a superannuation perspective. So where an employer has not complied with their superannuation obligation. So I'm going to cover historic non-compliance first, and then I'll be covering non-compliance with your pay obligations and what that means from a super perspective. But where it's a historic non-compliance, an employer is liable for the superannuation guarantee charge. The SGC consists of a superannuation shortfall calculated on a salary or wages base instead of OTE, plus a nominal interest of 10%, plus an admin fee of $20 per quarter per employee. Superannuation is a quarterly obligation. Therefore, an SGC statement is required to be lodged per employee per quarter where there's non-compliance in order to make good the shortfall. A Part 7 penalty also applies and is automatically imposed at a maximum of 200% of the shortfall. So it is very significant. There is a practice statement that's been issued, PSLA 2021-3, as I've set out on the slide. This was finalised last November and sets out the ATO's approach on remission of the penalty. So the ATO has discretion to remit a Part 7 penalty in part or in full, and recognises that the maximum 200% penalty should be reserved for rare cases where an employer has engaged in tax avoidance behaviour. The PSLA has a big emphasis on employer proactivity and the employer's SG compliance history. So if you can demonstrate proactivity around remediating any non-compliance and a strong compliance history, then we would hope that the Commissioner would exercise discretion to remit part of that penalty. Now, there is a 4-step penalty remission process that's set out in that ruling. Step 1 considers remission based on the employer's attempt to comply with their obligations through late payment. Step 2 considers remission based on the employer's attempt to comply with their obligations by lodging an SG statement. And then step 3 considers any increase or reduction in penalty based on the employer's compliance history. Step 4 considers any other mitigating facts or circumstances that warrant further remission. Okay, so that's the PSLA. I now move on to broader employment tax implications associated with pay and superannuation remediation. So with pay remediation, superannuation obligations, there's actually no need to complete an SGC because you are making the pay remediation today and the superannuation obligations arise at the point in time that you're making that back pay payment. So what I've just discussed around SGC, that purely relates to historic non-compliance or late payment of your SG obligations. So in terms of pay remediation, very important to ensure that you are complying with any superannuation obligations where you are making an additional payment to an employee to rectify any non-compliance or underpayments that have been identified. That's the first key issue. Secondly, payroll tax obligations. This is where we see employers overlooking the flow-on effects of pay remediation. There are other employment tax obligations that need to be considered. And from a payroll tax perspective, Revenue New South Wales has issued a practice note at CPN 021, which considers the payroll tax implications of superannuation and the SGC, with consideration to late payment of wages and compensation payments on those wages. So the guidance notes that payroll tax obligations arise on wages that are paid or payable, whichever comes first. That's really important. So when an employer is making remediation payments to back pay employees as a result of any salary underpayments, payroll tax obligations arise in the financial year that wages should have been paid. So if we move on to the next slide, the table here sets out a number of payment types and the corresponding taxing point for payroll tax purposes. So I've only included 4 examples here, but the practice statement does include quite a few different examples. So to begin with, historical underpayment of wages. Remediation of the underpayment will result in a payroll tax taxing point in the financial year in which the wages should have been paid. In other words, Revenue New South Wales expects a voluntary disclosure to be made in order to amend your payroll tax liability in the applicable prior years. For SG contributions relating to underpaid wages, the payroll tax liability arises in the year or month in which contributions are paid, so there's no need to voluntarily disclose. For SGC statements lodged by the employer, the year or month in which the statement is lodged triggers a payroll tax liability. So again, no need to voluntarily disclose. And for compensation for the late payment of wages, could be interest, for example, the Commissioner is of the view that the payment is not considered wages and as such does not trigger payroll tax obligations. Now, importantly, I mentioned Revenue New South Wales has issued this ruling. No other jurisdiction has currently issued a similar ruling. However, given that the state and territories do focus on harmonisation, we are expecting a similar ruling to follow in the other jurisdictions. So something to keep an eye out for. And I had to cover workers' compensation, of course. This is another obligation that needs to be considered where an employer is remediating any employee underpayments. Backpay is considered rateable remuneration, therefore needs to be taken into account when preparing a declaration of rateable remuneration. However, unlike payroll tax, which taxes taxable wages when they are paid or payable, the obligation typically arises when the payment is made. Now, I say typically arises because work cover is an area where there can be inconsistencies across the jurisdictions and across the different insurers. Therefore, we recommend employers engage with their insurers to confirm this position. So this wraps up my discussion on superannuation and employment taxes insofar as they relate to remediation. The key takeaway for employers who are making back pay payments to employees in order to remediate any wage underpayments is to ensure you consider the other resulting employment tax obligations. As I've discussed today, superannuation is key, together with other on-costs such as payroll tax and work cover. With the introduction of STP Phase 2 and the greater transparency of pay and superannuation data, together with the ATO's intentions to share data with other regulators, it is possible that the ATO will share back pay data with the applicable state revenue authorities, which could lead to detection of any payroll tax shortfalls if the required payroll tax adjustments and voluntary disclosures are not made. And then, of course, you can't forget work cover, as I mentioned. So lots to think about. And handing over to James to wrap up with employee share schemes. Thanks, James.
Thanks very much, Steph. That was really insightful. I'm going to go through some of the issues that arise for employers who are offering employee share schemes to their employees, go through some of the reporting obligations and then what needs to happen in case there needs to be an amendment. So the sort of key questions that need to be asked by an employer who's providing equity to their employees is firstly, is it reportable? If it is reportable, when is it reportable? What needs to be reported both to the employee and to the ATO? And finally, what happens if it's not done right? What happens with reporting amendments? So looking first at the question of, is it reportable? The key thing is, has the employee been provided with an ESS interest, and has that interest been provided at a discount? So what's an ESS interest? Well, an ESS interest can be a share, and that could be an ordinary share, or it could be a different class of share, a Class A share, Class B share that might have sort of different voting entitlements or rights to dividends, but all of those fall into the categories of shares. It can also include a stapled security. So that might be a unit trust which has been stapled to a share. So that's a share. What's a right? A right, it's probably two things that are more commonly understood. So it could be a stock option with an exercise price, or it also could be something described as a performance right. which is essentially a stock option with a nil exercise price. So both of those things fall into the category of right. There's also a third category called an indeterminate right. Now, this could be something where the employee is not certain what they'll actually end up with. And it might be for a couple of reasons. One, it might be that the employee doesn't know the number of shares that they're going to receive. So it could be that you're going to receive a number of shares based on achieving certain targets or certain performance categories at some point. Or it also could be that there is uncertainty as to what you will receive, so that the employee might receive cash or shares, and that is at the decision of the employer. So that's a indeterminate right. But importantly, needs to be at a discount. So if the employee pays full value for it, there's no discount and nothing that needs to be reported. What we're dealing here is where the employee either gets something for free or they get it at a discount, so they don't have to pay full value for it. So when is it reportable? Well, there are two basic times when these awards need to be reportable. There's a group that need to be reported upfront, and then there's also a group that fall into deferred taxation. And for the upfront, there's sort of two categories. The first category of upfront reporting applies to awards that are eligible for certain concessions or exemptions. So there is, in the share scheme rules, a $1,000 tax exemption. So if you provide shares or options to employees and they satisfy certain conditions, the employee may be exempt up to $1,000 worth of discount. So those amounts need to be reported up front. The second category is shares or options that are granted under a startup concession. Again, that's a specific set of rules in the share scheme provisions, which provide for quite favorable tax treatment for employees who receive those types of awards. Now, although there's nothing accessible for employees who receive shares and options eligible for the startup concession, there is nevertheless still a reporting obligation, and that happens up front. The next category of upfront shares and options that are required for reporting are those that don't satisfy those exemption or concession requirements and generally don't have a real risk of forfeiture. So for a share, if you grant an employee to a share, they don't pay anything for it, and there's not a risk that they will forfeit that share, then that share will be taxed at the time that it's granted to the employee. Slightly different rules for options. For options, the requirement is that there's no disposal restriction. So if you grant an option to an employee and they could immediately transfer that option to a third party or immediately exercise it, then that wouldn't have a disposal restriction and that would be subject to tax up front. Now, quite frankly, we don't often see options being subject to tax up front because generally you won't be able to dispose of them and there's generally an exercise period. So options rarely taxed up front. Shares, we do see them being taxed up front because not all of them have this real risk of forfeiture. So if you have a share and it does have a real risk of forfeiture, then you get deferred taxation. And generally, the taxing point is going to be deferred until there is no longer a real risk of forfeiture. And so quite often that might be described as vesting in plan rules or often documents. And so the taxing point will arise at that later point in time. However, if at the time the share was granted, there was also a disposal restriction, so it might say, well, your share vests after 2 years, but you can't sell it for a further 1 year, then in that instance, the taxing point is further deferred until when that disposal restriction ceases to apply. For options, it's generally going to be exercise. So if there's no restrictions on the shares, then it's going to be the time that the option is exercised. However, again, if at the time the option was granted, there is a disposal restriction on the share, so the employee exercises it and then has to hold on to the share for a further 12 months, for example, then the taxing point will be further deferred to when those restrictions on disposal cease to apply. A couple of alternatives. So if the employee sells their share within 30 days of the deferred taxing point just mentioned above for shares or options, then the taxing point actually gets pushed out to when that sale occurs. So that's something that employers may or may not be aware of. And if you are aware of it, you need to take it into account when you're working out both the amount to report as well as when to report that deferred taxing point. Finally, there's a maximum 15-year deferral period. So if awards, options aren't exercised for say 20 years, very unusual, you might have a taxing point earlier, and that needs to be reported. So turning to what is reportable. So again, it depends on the type of award and whether you're reporting it upfront or at the deferred taxing point. And there are various boxes on the form. So there's an employee share scheme statement that needs to be provided to your employees by the 14th of July following year end. And so if you're providing your employees with shares that are eligible for the $1,000 tax exemption, then those need to be reported at box D, and it's the market value. So generally it's going to be about $1,000 that's reported in that. If you have shares or options that are eligible for the startup concession, this is really just information reporting. And again, that's reported over on the right-hand side of the form, and the specific information that needs to be included there is the number of awards, the market value at the time that they're granted, the acquisition price or the exercise price if it's an option, and the date that it was acquired by the employee. The third area that needs to be completed is if there is shares or options that are not eligible for tax deferral, so they're going to be taxed upfront, and that's included at box E. And that's generally going to be the discount, so the market value of the award at the time of grant, less any amount that might be paid by the employee. And that amount, just the amount, gets reported in the box there. And finally, if the award is eligible for tax deferral because it's got some disposal restrictions or forfeiture conditions around them, at the deferred taxing point, that amount is included at box F. And that will generally be the market value of that share or option at the deferred taxing point, less the amount, again, if any, that's paid by the employee. And once again, if the employer knows that that's been disposed of within 30 days, then rather than the market value at the deferred taxing point, you'd include the sales proceeds that were received by the employee when they sold them within that 30 days. You'll note on the box there, there's also a space to include TFN amounts. We rarely see this. TFN withholding is only required if the employee hasn't quoted their TFN to the employer, and that'd be extremely rare. So don't often see that. So in addition to reporting to the employee, the employers need to also report to the ATO. And that's done through the online portal. And it can be done individually if you've got less than 50 employees. Otherwise, if you've got more than 50, then it needs to be done using compatible software. And so that generally involves getting assistance from a third-party provider to help with that reporting. You can't simply provide an Excel spreadsheet to the ATO, unfortunately. There's a bunch of information that needs to be included in that reporting to the ATO. Not surprising, the type of information, what's the plan, number of awards, market value, acquisition prices, discounts, that sort of information. And again, it depends on the type of award that was received and whether it's an upfront taxing or deferred taxation, that governs the amount that needs to be reported to the ATO. And that needs to find its way to the ATO before the 14th of August. So just a couple of other points to be mindful of with the ESS reporting. As I mentioned up front, generally no TFN withholding is required because the employees will quote their TFN, but it's possible. If the employee doesn't quote their TFN, that there will be a withholding obligation, and that will need to be both remitted to the ATO as well as reported. If the ESS award is granted to an associate rather than the employee, it's still the employee that gets assessed, and the reporting still applies for the employee. So, if your plan rules allow you to grant your award to a spouse or to a family trust or something like that, there's still taxing for the employee, and the reporting follows that. I've already touched on the deferred taxing point. If that happens within 30 days, it's the sale date that effectively is the deferred taxing point, and you need to report on that. If you don't know that information, then that's fine. You don't need to report at the 30 days. You will just report on the market value at the deferred taxing point based on the information that you have. And finally, if you have an employee who ceased residency, perhaps partway during a holding period or during the vesting period of their award, and then there is a subsequent deferred taxing point, you are able to apportion the gain and only pick up a portion of that gain at the deferred taxing point based on the amount of time the employee spent in Australia. So that reporting can be done that way as well in the ESS statement. Finally, I'm just going to touch on amendments. So there are some strict requirements around reporting amendments, and this might arise because you just forgot to report something, or it also might arise because you granted the employee an indeterminate right, and so you didn't know whether it was going to be settled in shares or cash, and you subsequently settle it in shares. In that case, the indeterminate right is treated as if it was always been a grant of shares, and you need to go back and consider, was there a disposal restriction or a forfeiture condition, and determine when was the appropriate time to report that indeterminate right when it's finally settled in shares. So that might mean that you need to go back to the time the award was granted if it had no restrictions on it, and report it at that point in time. The amendments need to be done within 30 days of finding out that there was an error, so there's a very short time frame for employers to understand what should have been reported, and then take the necessary steps to file the amendments. The other category where you might have some amendments is if you had an ESS award that was taxed at a deferred taxing point. So say, for example, an award that was taxed at the 15-year mark, but then was subsequently forfeited. Pretty unusual, but in that sort of instance, there might be a requirement to go back and amend the reporting to reflect the fact that the award was forfeited. So how do you do it for the employee? There's an amended ESS statement, so very similar to the statement that we were just looking at, and it's just tagged as amendment, and you just put the correct details on the statement and provide that to the employee. Similarly with the ATO, there's a few alternatives methods that are spelled out there for reporting the amendment to the ATO. You can either send the ATO a complete correct statement that has everything right and flagging those ones that were incorrect, or you could send them some information that just picks up the amendments and just highlights those ones to the ATO. But again, that information needs to be provided to the ATO on a timely basis. And it's also, of course, important to remember that that might mean that the employee needs to amend their income tax return. So there are knock-on implications for employees as well that are relevant. Now, I know I raced through that last bit because I'm just mindful that we're rapidly approaching midday. And so I'd like to thank you, everyone, for attending the session. We did have a couple questions that popped up, but I'm just mindful of time. So rather than deal with those now, we'll send some responses out to those that raised the questions on the way through. They seem to be quite specific questions, and the general stuff that's popped up in questions we've covered on the way through. So in addition to thanking Stefanie and James for their presentations today, I'd just like to flag that or advertise our upcoming Working in Australia sessions. So we have fringe benefits tax compliance. We're getting very excited. FBT is not too far away. Once we get past the annoyance of Christmas, then we'll be into the FBC season, and that'll be super exciting. And so we'll have a session in March to go through updated changes and the like for FBT. And then, like as we've done in prior years, we'll also have a session for year-end employer obligations in early July. So if you want to attend those, please go online, register, and we'd love to have your attendance at those sessions. So once again, thanks very much to Stefanie and to James, really, and to everyone who's joined the session today, and those who helped in the background with slides and getting this session up. Thank you very much, and I hope you have a wonderful rest of your Wednesday. Thanks very much for joining us.